What's going on? Welcome to my channel, fellow income investors. I am the covered call guy, and my YouTube goal here is to create $120,000 in annual passive income using covered call ETFs. My projected annual dividend / options income right now is about $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and $9.42 per hour. Legal disclaimer before I start: though this content is for information and educational purpose only, it should never be considered financial investment or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate, incomplete, or just flat out wrong. So please always conduct your own due diligence and consult with a qualified, licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, today's video is kind of a reminder, especially for those who are new, but still a reminder for those like myself that's been investing for a while. We have to be aware, right? Most income investors will buy slop, right? 95% of the ETFs out there are slop, right? We have to find the 5% that are actually great, excellent, elite income ETFs or income stocks, right? The core thesis of this video is that yield is meaningless if I'm truly just getting my own money back with the NAV going down, right? That is the slop, and that is essentially 95% of the products that get pushed out. Right, so let's look at the high yield, right? This is the high yield lie, right? This is my central thesis here, and I want you to focus on this with me, right? This is the hard truth, because my thesis is that yield is a meaningless metric in isolation. When you look at it, when you look at just the yield, you are looking at a meaningless number, right? In many cases, it's actually a contrarian indicator of quality. The fund must aggressively hype on social media, often display the most severe degradation of NAV. If you bought the hype, you got played, right? Let's gonna break it down. We're gonna look at the autopsy plan of how we can actually look at, my thesis here. Part 1 would be the mechanics, how the trap works. Part 2, when we look at the 2026 market audit, right? We're going to be testing the thesis for 2026 look. So yes, 2026 has just started, but we're going to be looking at it from that perspective. It's the best way moving forward, because if we look back too much, the market for 2026 may not have been the same, right? The goal here, we're going to separate the 5% elite from the 95% slop, right? And I'm trying to at least give you information on how you can break that down, right? If it's hyped on the internet, it's probably destroying your wealth. You're just buying good PR. All right, so what exactly is ETF slop, right? So this is my definition, right? ETF slop refers to the ETFs engineered primarily to harvest assets under management, right? That's by advertising eye-popping distribution rates, right? Often exceeding 10, 20, or even 50%, or even higher, right? The mechanics behind that is that they pretty much rely on mechanical derivative strategies, which is at the money cost that mathematically cap your upside while exposing you to full downside risk, right? They capitalize on your behavioral bias, which is yield chasing, right? When you become a yield chaser, you essentially will lose. It's just a matter of when, not if, right? My verdict here is that they are harvesting fees, not growing your wealth. All right, let's look at the psychology trap, right? And why do we fall for it, right? So trap 1 is the cash flow fallacy, right? If you receive $1 in dividends from a stock that drops $1 in value, you have generated basically $0 in economic value. Yet receiving that $1 creates a dopamine response, right? So with these ETF slops, you're just paying active managers to lose your money, right? Congrats, you played yourself here, right? Trap 2 is the average down trap, right? When slop funds decline, which is a structural inevitability, right? Eventually, it will collapse. It will collapse. Inevitability. Is inevitable, right? It's going to happen, right? Investors are encouraged to lower their cost basis. This is a capital allocation error. You are pouring fresh liquidity into a decaying assets class, right? When you notice this, before you even buy it, when you're looking at it, you're just gonna tell yourself, wait, why would I'm throwing good money into burning firing pit? I'm essentially just making the fire bigger while burning cash. And that's it. This is the trap 2. Right? Smart money versus dumb money. the smart money rule, right? Let's look at how smart money plays. Well, institutions, right? They're pouring money like pretty much the big pensions or sovereigns do, of course, never chase the yield, right? They manufacture it. They almost universally avoid retail option ETFs. Why? Because institution needs principal protection, right? They know that a 50% yield is mathematically impossible without liquidating the asset base over time. Let's look at how they would actually do it, how pros actually invest. They have private credit, right? They act as the bank, right? So they hold senior secured loans, right? First lien. If the company fails, they get the building, right? Retail option funds or unsecured fluff, right? Structural arbitrage, right? They buy closed-end funds, right? CEFs, when they trade at a 15% discount to the NAV. They're buying $1 of asset for 85 cents. And that right there is instant mathematical profit, right? So objective here is if you think it's too risky for a pension fund, it's probably too risky for your retirement, for your portfolio. All right. So what is the mechanics of capital destruction? Let's look at NAV, right? NAV erosion. The scoreboard here is if NAV is eroding over a 3 to 5 year period during a flat or bull market, the fund is structurally broken, right? It happens when the distribution rate exceeds the total return. This leads to what we call the death spiral. As NAV decline, asset available to generate income shrinks, right? To pay the same dividend, the fund must generate a higher percentage field, right? Forcing more risk and eventually collapse, right? A high yield on a shrinking asset base is a ticking time bomb, right? So let's look at return of capital, right? The good versus the ugly, right? Let's look at destructive rock, which is slop, right? Liquidating asset that hasn't appreciated to pay a dividend. NAV will drop. You simply receive your own money back, right? Minus the management fee, which nobody talks about. This is what drags you down, and this is what you ultimately lose. And then on top of that, taxes. Basically, these active managers are saying thanks for the yacht, suckers, right? And that's how it is. That's how you should see it. Constructive rock, which is more elite. This is what we're looking for and focused on. Cash flow shielded by non-cash expenses, right? Depreciation lowers your cost basis and defers taxes. This is tax efficient, tax deferred compounding. Two different realities here, right? I need to know if I'm getting tax efficiency or liquidation. All right, let's look at the Yieldmax extremes, right? We're going to do a case studies of TSLY. This is the path dependency math, right? These funds sell call options that cap your upside. And here's how, here's the math on why you lose. If the stock drops 50% from 100 to 50, you need a 100% gain just to break even for the $50 back to 100. However, for these type of stocks, your upside is already capped at the option strike. Mainly about 2% per month, right? This is the impossible client. It's impossible because your upside is capped. You can never catch up to the crash. You participate in the full elevator down, right? If you have to take the stairs back up and the door is locked at the second floor, how are you going to get back up? Not possible, right? This is why high volatility plus capped upside equals guaranteed mathematical decay, right? Look at TSLY. It's already down 83.50 all time, right? You take all the risk and cap your own reward. All right, let's look at cover call evolution, right? These are the JEPI defenses, right? Gen 1 of passive at the money is QYLD. So these systematically right at the money calls. The flaw here is that it caps upside at 0. In a tech bull market, QYLD will underperform massively as NAV erode. And then right here, you kind of have a Gen 2, how they solve it, right? This is the JEPI powerhouse. This is where they dominate, right? JEPI does get hated on for the tax efficiency, which is ordinary income. But here's the reality of it. JEPI is so good at protecting your principal, right? Because it uses active defensive stock selection. JEPI has historically performed better than both SPYI and GPIX during downturn markets, right? It holds up when the market floor falls out, right? I'd rather pay the taxes if it means I don't lose my principal. Right? I know I talk about JEPI a lot, and there's probably a lot of hate with JEPI or JEPQ because of the ordinary income, but they perform so well in terms of being a ballast for your portfolio. All right, let's look at the Gen 3. These are the elite standards, the gold standards, right? SPYI and QQY. Of course, they have structural advantage, right? They're out of the money call. Instead of capping upside immediately, right? SPYI and QQY, right, calls roughly, I think they do about 5% out of the money. This allows the fund to capture the market upside before the cap kicks in, right? So structural advantage 2 is section 1256. This is where they use the index options, right? SPX and NDX. So under the sections under IRS section 1256, where they get their name from, right? The gains are taxed at a hybrid, right? So 60-40, so a blended rate of just about 20 something, right? Regardless of the holding period. So it captures upside and save on taxes. All right, let's look at BDCs, right? This is the management structure divide, right? External management is about 95%. So base fees tied to asset under management incentivized to grow as large as possible, offering issuing shares below NAV or taking growth for growth's sake risk. And then you have to look at the internal management. This is about the 5%, right? This is the better one, right? So management employs directly and owns the stock, paid on shareholder returns as BDC grows, fixed costs spread out, right? Lowering the expense ratio. So internal management often aligns their wallet with yours. So understand when you're buying these BDCs. Right, so let's look at some BDCs kings, right? I'm gonna say Main and CSWC, right? So Main's free money mafia. Main is probably my #1 BDC that I would buy all day, every day, right? So Main Street Capital, Main trades at a 50% premium to the NAV. This is what I would say is a superpower for Main, right? The math is that they do issue new stock at $45. They take the cash and lend it out at a fair value of $30, right? The difference is $15. Instantly increases the NAV for every existing shareholder. It is literally accretive growth printed from thin air due to their reputation. Now, of course, the downside is they could harm the reputation by overdoing this, okay? Let's look at the second one of CSWC, right? Dividend coverage. This is Capital Southwest. It's probably my top 5, or at least in my top 10. Well, I want to put this one out here. I don't know if a lot of people know this, but it does maintain a coverage ratio of 110% plus. So that means for every $1 they pay you in dividends, they earn $1.10 in actual cash, right, interest. Right, so that extra 10% is the spillover. It acts as a safety savings account to ensure they never have to cut the dividend, even if the economy slows down, right? So looking at these two is I pay a premium for premium management. Okay, let's look at CEFs and REITs, right? These are the anti-slop versus yield traps. So CEFs, right? These are the elites, right? For the most part, let's look at ADX, right? Expense ratio 0.50, pay 6% from capital gains. UTG, right? Never cut distribution since 2004. Steady NAV growth. Let's look at REITs, right? O and VICI, pretty much the two most dominant REITs that you can buy as a single stock, right? Own the landlord, right? Like Caesar's Palace, 100% rent collection and inflation-linked leases. Of course, I would say when you're buying REITs, look for the NNN, the triple N leases. Those are probably the best. And then REIT traps, right? Mortgage REITs could be NOY or AGNC. These are where they catch you by the yield, right? Pretty much like hedge funds, book value collapse 50% over 10 years. Own the landlord, not the mortgage gambler. In my opinion, I would say go for the other two. All right, let's look at taxes because this will help you retire ASAP, right? This is the reality of taxes. Pure income like taxable accounts. If you need cash now to live on, BDCs and REITs are a tax drag, right? Ordinary income up to 30%. That is the downside of it, of course. That is what it is, right? So the solution, if you don't want to or you want to take into the switch, do so to SPYI and QQI. This is where section 1256 plays in, right? Your effective tax rate is about 26% blended. You keep 10% more of your check for bills today. Of course, it is options premium, so it's not as steady as the monthly as your payout would be for BDCs and REITs. All right, for future growth, if you don't plan on retiring now, maybe in 10 years, maybe in 15 years, right? There's the IRA and 401k, best for BDCs like Main, CSW, and REITs, of course, right? The objection is, isn't this only best if I'm not retiring for 20 years? Reality is no. Even if you retire in 5 years, right? Shielding a 10% yield from a 37% annual tax drag puts more cash in your pocket to reinvest today, right? So maximize spendable cash today. All right, the convexity trap, right? Defining slop by math. We're going to take a look at BLOX, right? This does crypto. I'm going to say, even though people think this is a slop, I'm going to say this is a possible slop because of the structural drag. Okay, the math here is that it holds 100% downside plus some capped upside. So if the scenario here is BTCs drop 20%, the fund drops roughly 15 to 18%, right? BTCs recover 20, the fund recovers capped amount 2, 3, 4, 5%, whatever it is, right? My verdict here is it is great for short-term income, potentially dangerous for short-term capital due to negative convexity. Remember, for crypto, I would say possible slop because it is a speculative asset. People get into this for high yield, high reward. So understand when you're playing into crypto, okay? And what is elite? Well, that's SPYI, of course, right? That's the S&P 500. I'm going to say this is not slop. It has structural balance. The math here is 5% out of the money cost plus 1256 tax edge. Scenario here is if SPY drops 5%, the fund, of course, drops. SPY recovers 5%, the fund captures most of it because calls are out of the money. Verdict here is efficient income generation that balance both yield with NAV preservation, right? Look at the two. Volatility plus capped upside equals mathematical decay. It is. Over the long period, if you're holding it for 10, 15, 20, 25, 30, 35, 40 years, you're going to have to look at how volatility plays with capped upside. All right, let's look at the house money reality check, right? My warning here is everybody talks about house money, but true house money status is only achieved if total return is positive. If the NAV erodes faster than dividends are paid, which becomes destructive rock, you are simply withdrawing your own money at the ATM that charges a management fee, right? Slop erodes quality compounds. So understand what house money is. I see a lot of people talk about it, and I've mentioned a few times, not too many times, but I know a lot of people are mentioning, well, I'm going to just wait for the house money. All right, part 2. This is the breakdown of the 2026 market autopsy, right? So this is my rigorous data-driven test of the thesis. My structural engineering is now your biggest risk. I talk about this with structural being the most important. Right? Insider ownership, right? This is the conviction gap. The elite will have skin in the game, right? Main executives are active buyers, right? The director, Foster, holds about $1.8 million in shares, right? And ARCC, another great BDC. The CEO invested hundreds of thousands of personal capital in late 2025. Where the slop, if you're looking at the slop, they have almost zero ownership, right? Let's look at the reviewing filings for QYLD or Yieldmax, right? Reviews manager ownership is often none or just like $1 to $10,000. This is a moral hazard to me, right? They are paid to sell the product, not preserve your capital. If they don't own it, why should you? And that is something you got to ask yourself here. All right, organic versus synthetic yields. These are the mechanics behind underneath the hood. Organic yield, right? Or capital performing a function, which is like lending, which, you know, BTCs like Maine does, reported a NII of 97 cents per share, right? Covering dividends by 127%, includes equity kicker gains, right? So they pay about what, 25 cents or so per share, I think, give or take. I haven't checked. So pretty much could cover. Right, synthetic yield is often the option trap here, right? Generated by selling options. TSLY data nearly looking at early 2026. 71% of dividend return negated by 44% capital loss. This is funded by systematic liquidation, right? I want slow profits, not slow liquidation. All right, let's look at efficiency and fees. This is the silent killer. You have to look at this. 1.3% main efficiency, internal leverage, versus 1.28% Yieldmax fees, right? Double dip, fee layering, never pay double for underperformance. Fee layering, right? Fees on top of fees, or funds of funds, are very, very sneaky. You have to beware. All right, so why 95% is slop, right? Of course, is the fee structure trap. Let's look at the fair alignment. This is the quality of 5%. Elite BDCs like BXSL and ARC have a total return hurdle, right? You have to look back at the charts, right? If they lose your capital, right, the NAV drop, they are contractually banned from taking their incentive fee until they earn it back. This is great. This is why they do perform so well, right? They only win if you win. All right, and let's look at the asset gathering model, right? This is the slop. This is 95% of it. Most high yield ETFs have no performance hurdles, right? They collect their 1% fee every single day, whether the fund is up 20 or down 80%. They are incentivized to sell hype and gather assets, right? Not to generate sustainable returns, right? So my goal, your goal, align their paycheck with my performance. All right, crypto and the slept on alternatives. All right, so crypto, speculation or slop. This is where you have to divide yourself. I'm gonna say almost all of them are pure speculation. Right, context does matters. Crypto market has been down, so funds like BTCI reflect that the underlying volatility. It isn't necessarily broken structure, but the risk, right? Selling options during the crash, capture recovery. This is a speculative volatile play, not a stable income generator. Pretty much used for bets, not bills, right? We're betting on the high risk, high reward returns of this. And then, of course, the slept on is the true quality. Looking at UTG, they haven't cut distribution since 2004. And then TRIN, right? TRIN, venture debt with 13%. It is backed by lending expertise. Boring consistency beats wild speculation every day, all day, right? Boring is beautiful. Always remember that. All right, the quality versus slop matrix. There's a cheat sheet. Pause it. Essentially, right, follow the insiders, demand hurdles, and reject fee layering. This is just a kind of put together. I talked about it. I'm gonna pause the video. Just take a quick look at the matrix. This is it. All right, so what do you agree on? All right, we covered a lot of ground on the 5% quality versus 95% slop. Do you agree that yield is meaningless without NAV stability? Because, I don't think anybody would disagree with that. Are you strictly team quality, or do you trade volatility, right? As you know, I do a little bit of both. I have Maggie and BTCI as my straight pure volatility, right? If you enjoyed this video, give me a subscribe, a like, leave a comment down below. Of course, if you agree or disagree and what elite or slop you're holding, right? My goal is to always help you keep your money, and I know you guys do your best to leave comments and fact check me to help keep my money. That's why I appreciate all of you guys. Thanks for watching. Stay tuned. Catch all of you guys on the next video.